Trillions of dollars cross borders every day, forming the nervous system of our global economy. Yet, while data travels at light speed, most capital crawls through a century-old maze of correspondent banking. When a company in Bangkok pays a supplier in New York, the money passes through middleman banks, each taking a cut. This is the world of Nostro accounts, trillions sitting idle in foreign bank accounts just to facilitate slow, manual trades. Your money is effectively trapped for days, bleeding fees at every stop. In the modern era, this is a systemic bottleneck. This is why the world's largest financial institutions are looking for a logical fix: a surgical re-engineering of the global financial plumbing. This is the mission of the XRP Ledger. We are talking about moving value as easily as we move information. Today, we look under the hood to see how this transition is happening in real time. Quick heads up, this is educational content only, not financial advice. Crypto assets are high risk. You could lose all your money. Also, some links in the description are affiliates that help support the channel at no extra cost to you. Always do your own research. To understand the future, we must go back to the origins. The XRP Ledger launched in June 2012 by engineers David Schwartz, Jed McCaleb, and Arthur Brito. They realized that while Bitcoin was revolutionary, its proof-of-work system wasn't designed for high-speed global banking. They wanted to build a decentralized ledger technology that was faster, cheaper, and more sustainable. This led to the creation of Ripple, built to act as the professional bridge between open-source tech and traditional finance. The leadership team is seasoned. CEO Brad Garlinghouse is a veteran executive from Yahoo and AOL. Alongside him is Executive Chairman Chris Larsen, a fintech pioneer who co-founded eLoan long before crypto was a household name. These individuals have spent decades in regulated environments, facing the scrutiny of government agencies. This compliance-first mindset has defined the project's journey. They've navigated over a decade of market cycles and a 5-year legal battle that reached a total resolution in 2025. Today, that resolution has left Ripple with absolute regulatory clarity in the United States regarding secondary market sales, providing a clean runway for institutional adoption. This long-term persistence is a signal of maturity in an often volatile industry. Now, let's talk about the institutional power players. Why are giants like MasterCard and SBI Holdings choosing this network? The answer lies in ISO 20022. This is the new international language for electronic data exchange between financial institutions. While many older databases are silos, the XRP Ledger was engineered to be natively compatible with these global standards. Ripple was the first DLT-focused member of this body, ensuring their tools plug directly into the existing infrastructure of the world's largest banks. Consider Ripple's acquisition of G-Treasury. By acquiring a leader in treasury management, Ripple now provides access to treasury operations for many of the world's largest corporates and Fortune 500 clients. This is a direct integration into the software that manages vast amounts of corporate cash flows annually. We are also seeing significant engagement from the banking sector. Giants like Standard Chartered and SBI Holdings are using these rails to bypass the slow settlement times of the legacy SWIFT network. They are moving real money in real time across borders. With spot XRP ETFs now live and managing billions in institutional capital, the Wall Street seal of approval is a reality. Even central banks are in the room. Ripple has been tapped for exploratory pilots by several nations, including Palau and Bhutan, to test central bank digital currencies on specialized versions of the XRP Ledger. Seeking the 100% uptime and sub-second finality it has delivered since 2012. Let's look at the mechanical deep dive. How does a decentralized system settle trillions without a central boss? Imagine sending a cargo ship from Thailand to Brazil. In the old system, that ship stops at 5 middleman ports, to swap currencies and verify paperwork. Each stop adds cost and time. It's slow and expensive. XRP acts as the universal bridge asset. Instead of those 5 stops, the system converts your Thai baht into XRP in 3 seconds. That XRP flies across the digital ocean and is instantly converted into Brazilian real at the destination. But how do we know the trade was valid? This is where digital notaries or validators come in. On the XRP Ledger, there isn't one bank keeping a secret book. Instead, there is a global network of independent servers that maintain an identical copy of the ledger. Every 3 to 5 seconds, all these notaries look at a batch of new transactions and ask, does this follow the rules? They don't use energy-heavy mining. Instead, they use a consensus protocol. If 80% of these independent notaries agree that the transactions are valid, they close that specific ledger version and lock the page. This is what we call finality. Once that ledger is closed, it cannot be changed or reversed. It is a mathematically guaranteed record of value moving across the globe at the speed of the internet, for a transaction fee that is literally a fraction of a penny. So what? How does this affect your wallet? First, consider the hidden tax. Every time you buy an imported product, you pay for the banking fees that the manufacturer and importer paid to move money across borders. If the XRP Ledger can save a global supply chain significant percentages in liquidity costs, that capital can eventually be passed on to you. In an era of high inflation, increasing the efficiency of our financial plumbing is an effective way to lower the cost of living. Second, think about liquid freedom. Moving funds abroad often takes days. Your capital is held hostage by outdated systems. DLT in retail banking means the era of the waiting period is ending. It means your money moves as fast as your ideas. Finally, there is the pre-funding problem. Small businesses currently keep billions sitting idle in foreign bank accounts just to prove they can pay international bills. This is dead capital. By using XRP as a bridge, that money is freed up to go back into the real economy. This stimulates growth, creates jobs, and allows the next generation of entrepreneurs to compete on a global stage, without being crushed by the high cost of entry. It turns a static financial system into a dynamic one, where value flows as freely as the internet allows, benefiting everyone from the corporate treasurer to the retail shopper. To be your trusted friend, I must provide an honest audit. No technology is perfect. First, there is legacy inertia. SWIFT is not just going away. They are building their own digital upgrades and central bank bridges to maintain their dominance. Ripple and the XRPL community must prove that their DLT is significantly more cost-effective to justify the massive change management costs banks face when upgrading. Second, there is concentration. While the XRP ledger is decentralized, Ripple still holds a significant amount of the total XRP supply, roughly 33 billion tokens as of early May, in time-locked escrow. Although they have a transparent record of releasing these funds and often re-locking the majority, critics argue this creates a central point of influence. Monitoring how this supply is distributed is a key metric for long-term health. Finally, there is the regulatory horizon. While the 2025 resolution provided a massive sigh of relief, the work isn't done. New regulations regarding stablecoins, privacy, and cross-border data flows are being written in real time. Any project at this scale lives or dies by its ability to stay ahead of these evolving rules. The surgical investor knows that regulatory clarity is a double-edged sword. It brings in big institutions, but it also brings stricter oversight and higher compliance costs. These are the hurdles that will determine if XRP becomes a global standard or remains a niche utility. The XRP Ledger is a veteran in an industry of newcomers. It has the partnerships, the ISO 20022 alignment, and a track record of over a decade of 100% uptime. Whether it becomes the global brain for liquidity depends on its continued ability to bridge the gap between DLT potential and institutional requirements. What do you think? Is the era of waiting 3 days for a wire transfer finally over? Drop your thoughts in the comments. If you found this institutional breakdown valuable, hit that like button and subscribe so you never miss a video. If you're ready to take the next step in your journey, check the links in our description. Thanks for watching Crypto Pulse 360. Stay pulsed.